Hi folks, welcome to another episode of Who Said What. I'm Kashish, filling in for Krishna. If you're new here, here's the quick context. The idea is simple. We pick the most interesting, sometimes spicy comments from business leaders and fund managers and break down what's really going on behind them. We've been tweaking the format a bit, and this is a new version I'll be trying over the next couple of weeks. So if you like it, let me know in the comments. And if you don't, go easy on me, please. This builds on a newsletter we run called The Chatter, where we track what company managements say in their earnings calls. But instead of looking at those comments in isolation, this format zooms out. We track one theme across companies and over time to see how the story evolves. The goal is to connect the dots and understand the deeper shifts shaping an industry. For today's episode, I wanted to answer one question. Has the microfinance credit cycle turned? To get there, I went through 144 con calls from 18 Indian companies over 8 quarters. Here's what we found. In March 2024, the Indian microfinance industry was in a celebratory mood. Asset quality had recovered from the pandemic, growth was strong, and guidance was really ambitious. The sector had dispersed record volumes, and the worst of COVID-era stress was firmly behind. Satin Credit Care's HP Singh called FY24 a momentous chapter in the company's 33-year journey. Muthoot Microfinance CEO saw a clear path to 4.5% ROA. Credit Access Grameen, the country's largest pure-play microfinance NBFC, set its sights on numbers that would have been seemed outlandish just 2 years earlier. Bandhan Bank, which had spent 3 painful years cleaning up pandemic-era stress in its microfinance book, the emerging entrepreneur's business in Bandhan parlance, declared the legacy behind them. Its SMA 0 pool had halved, slippages were trending down, the technical write-off on the old book was done. Now, SMA 0 pool is the set of loan accounts that are overdue by up to 30 days. Indicating the earliest stage of repayment stress. And slippages are loans that move from standard performing to non-performing status during a period. When analysts asked Credit Access Management Director what risks he saw on the horizon, his response carried the confidence of a man who had navigated COVID, demonetization, and the Andhra Pradesh crisis, and come out the other side each time. It was a reasonable statement grounded in history. Every previous microfinance crisis, Andhra Pradesh in 2010, demonetization in 2016, and COVID in 2020, had been triggered by an external shock that no one could have modeled for. The sector's risk management frameworks were built around this assumption. The threats come from outside, and when they pass, business returns to normal. Not everyone agreed. A few voices struck a different note that quarter. Kotak Mahindra Bank's new CEO, Ashok Vaswani, looked at the same data and saw a warning sign rather than an all clear. HDFC Bank was quietly building buffers while the sun was shining, creating what it called counter-cyclical provisions, essentially setting money aside during good times for the bad times it expected would eventually come. IndusInd Bank, one of the largest MFI lenders through its subsidiary BFIL, was even more specific about where it saw cracks. Its CEO, Sumant, said that the bank had spotted stress building in Punjab 11 months before the rest of the industry acknowledged it. Whether the early detection translated into early protection would become one of the more revealing questions of the cycle. The first tremors arrived in Q1 FY25, the April-June quarter of 2024. A brutal heat wave across northern India made fieldwork difficult for loan officers accustomed to collecting repayments door to door. General elections in April and May disrupted collection schedules. In several states, political activists ran Karj Mukti Andolans, loan forgiveness campaigns that encouraged borrowers to stop repaying. These were plausible temporary explanations. Heat waves pass, elections end, but underneath the seasonal noise, something structural was breaking. At IDFC First Bank, the JLG collection efficiency, which is Joint Liability Group, the percentage of current bucket borrowers who pay on time slipped from 99.7% to 99.2%. Half a percentage point sounds trivial. In microfinance, where the entire model depends on near perfect repayment discipline, it was a red alert. A brief detour here is useful to understand what was actually going wrong. Microfinance in India works primarily through the joint liability group model. Small groups of borrowers, typically 5 to 10 women, who collectively guarantee each other's loan. The model's genius is that it replaces traditional collateral with social pressure. If one borrower defaults, the group faces consequences. It works remarkably well in normal times, keeping credit costs at 1.5% to 2.5%, despite lending to some of the most economically vulnerable households in the country. But the model has critical weakness. It doesn't control how many groups or how many lenders a single borrower joins. And since 2022, something had quietly shifted. Credit Bureau data showed that the borrowers were taking on loans from more and more institutions simultaneously. Ticket sizes were creeping up. Total indebtedness per borrower was rising fast. Fusion Finance, a mid-sized NBFC MFI, laid this out in stark numbers. In 12 months, the share of borrowers carrying more than 1 lakh rupees in microfinance debt had jumped by 10 percentage points. And these were just the loans visible to credit bureaus. Equitas Small Finance Bank's veteran founder, P.N. Vasudevan, who had been in microfinance for nearly 2 decades, identified another layer that was harder to crack. Spandana Spurti's data quantified the damage from over-leveraging. Borrowers with 5 or more lenders were just 12% of the company's AUM, but contributed 21% of its arrear bucket. The more lenders a borrower had, the more likely they were to default, and the industry had spent 2 years adding lenders to each borrower's profile. The most important observation of Q1 came from Vasudevan, who named what nobody else was willing to say clearly. For the first time in living memory, the crisis wasn't caused by something that happened to microfinance. It was caused by microfinance itself. Not everyone agreed with this framing. Spandana's MD, Shalabh, pushed back on the idea that over-leveraging was systemic. Within 2 quarters, the data would prove him wrong. In July 2024, MFIN, the Microfinance Institutions Network, which functions as the sector's self-regulatory organization, rolled out what became known as the Guardrails. These were a set of industry-wide lending norms agreed upon by members representing roughly 87% of microfinance market, aimed at curbing the over-leveraging that was now clearly driving the stress. The key rules were no borrower should have loans from more than 4 microfinance lenders. Total unsecured indebtedness, including microfinance, should not exceed 2 lakh rupees. And lenders were required to check bureau data before every disbursement, not just at onboarding. The guardrails were a significant step, but they were forward-looking. They could prevent new over-leveraged loans from being created, but they couldn't fix the existing book. Borrowers who had already had 5 or 6 lenders would continue to struggle. The stress already embedded in portfolios would need to be absorbed through provisions, write-offs, and time. The impact on new business was immediate. At Muthoot Microfinance, about 11% of loan applications that would previously have been approved were now being rejected under the new rules. Satin Credit Care reported that at a time the guardrails kicked in, just 1% of existing clients exceeded the 4-lender cap, a sign that some companies had been more disciplined than others. And then Fusion stopped disbursements entirely in its 104 branches. Credit Access tightened credit filters. Spandana paused new member acquisition in 230 branches and stopped sourcing new-to-credit customers altogether. The industry was simultaneously trying to fix new pipeline while absorbing the damage from the old one. Credit Access team tried to quantify this timeline, but that guidance would not survive the next 90 days. By September 2024, the scale of the problem was undeniable. What had started as a stress in some pockets was now a full-blown industry credit cycle. The heat waves and elections were months behind, but collection efficiencies were still deteriorating. Equitas Vasudevan captured the moment of realization. Credit Access Grameen, which 6 months earlier had guided for 23-24% portfolio growth and 5.4% ROA, rewrote its entire outlook. Growth guidance has halved. ROA guidance cut nearly by 40%. Credit cost guidance doubled. And Credit Access was among the better positioned players. It had been conservative relative to its peers, with a diversified geographic footprint and a long track record. For the more concentrated and leveraged players, the numbers were far worse. Fusion Finance reported a quarterly credit cost of 693 crore rupees, a number large enough to trigger covenant breaches with lenders. This is worth pausing on. Fusion's borrowing cost and credit lines depended on maintaining certain financial ratios. When its losses blew through the thresholds, its own access to capital came under threat. The stress wasn't just flowing from MFI borrowers to MFI companies. It was threatening to flow from those companies to their lenders as well, creating a potential second-order shock. IDFC First Bank's V. Vedyanathan, who had spent the previous quarter framing the Tamil Nadu floods as a one-off episode, acknowledged the broader reality and took an aggressive provisioning stance. Ujjivan Small Finance Bank, one of the larger microfinance-focused small finance banks with a significant presence in southern states, saw its PAR, the portfolio at risk, measuring any loan that's even one day overdue, climb sharply. IndusInd Bank CEO Sumant, who had claimed to spot the trouble 11th months early in Punjab, was now projecting confidence that the worst could be over within weeks. But the truth is that timeline would prove wildly optimistic. Suman himself would not see it through. Within months, he would exit the bank amid a governance crisis triggered in the bank's derivative portfolio. Vasudevan, characteristically more measured, offered the hardest truth of the quarter. Q3 FY25, October through December in 2024, was when the stress peaked for most companies. Bandhan saw microfinance slippages of rupees 1,200 crores in a single quarter. Its collection efficiencies outside West Bengal dropped to 96.3%. Saturn Credit Care's PAR 1 rose to 6.8%. RBL described conditions on the ground as being in a flux. But this quarter also contained the single most important inflection point of the entire cycle, December 2024. For months, the data had been uniformly grim. Then almost simultaneously, company after company reported the same thing. First, material improvement in the current bucket, the pool of borrowers who are not yet overdue. When this pool stops deteriorating, it means fewer borrowers are falling into trouble for the first time. It doesn't fix the existing NPAs, but it signals that the pipeline of future stress is narrowing. Credit Access MD, who had initially expected the peak in September, acknowledged the delay but confirmed the reversal. RBL Bank saw the same inflection. Fusion's Devesh Sachdeva, whose company had been among the hardest hit, was watching a different metric. The new loans disbursed under tighter guardrails since August. This was quietly one of the most significant data points of the cycle. Loans written under the new guardrails weren't just marginally better. They were performing like pre-crisis vintage. The guardrails were working. But Bandhan's new MD, Parth Pratim Sengupta, who had replaced Ratan Kesh in yet another leadership change during the crisis, offered a note of caution that tempered the optimism. The SMA-0 book was improving, but the backlog of loans already deeper in areas still needed to work through the system. The green shoots were real, but the cleanup was far from over. Q4 FY25, January through March in 2025, became the quarter of reckoning. The turn in collection efficiencies was confirmed, but the damage from the preceding 3 quarters had to be absorbed. Companies took massive write-offs to clear the decks. The numbers were staggering. Equitas SFB revealed the full toll. Its microfinance credit cost went from 2.3% in FY24 to 11.37% in FY25, a near 5-fold increase that wiped away 630 crores of profit and dragged the bank's overall return on asset to just 0.32%. Spandana Spurti posted a net loss of 1,000 crores for the full year. Credit Access wrote off 1,100 crores, including 480 crores in accelerated write-offs of non-paying accounts. Muthoot Microfinance saw its GNPA climb to 4.84%, but its CEO called this the peak. RBL Bank took perhaps the most aggressive provisioning step of the entire cycle, writing its GLJ net NPA to 0 in a single quarter. And then there was IndusInd Bank. In an industry already reeling from credit stress, IndusInd disclosed something that went beyond a credit cycle. It was governance failure. An internal review found that microfinance loans at its subsidiary, BFIL, had been misclassified, concealing 1,885 crore rupees in under-provisioning and unrecognized NPAs. The disclosure triggered a leadership overhaul. Rajiv Anand replaced Suman as MD and CEO. The microfinance subsidiaries governance framework were restructured for greater transparency. It was a stark reminder that credit cycles don't just stress balance sheets, they expose operational weaknesses that good times had papered over. Meanwhile, the industry's aggregate footprint was shrinking. This is a number that didn't get much attention in individual earning calls, but told a dramatic story at sector level. From 4.4 lakh crores to 3.5 lakh crore rupees in just 15 months, the entire microfinance industry shrank by 20%. That's roughly 90,000 crores of credit that was withdrawn from some of the poorest households in the country. The human cost of an industry correcting its own excesses. IDFC First Bank's Vaidyanathan, whose bank had taken provision hits early and heavily, offered a framing that captured what this quarter was. Not the start of a new problem, but the crest of a wave. The first sign that the recovery was real, not just hoped for, came from Credit Access Grameen's Q1 FY26 results. The company that had slashed guidance a year earlier now reported its highest ever first quarter disbursement. Note the leadership change here too. Ganesh Narayan had taken over from founding MD Uday Kumar Hebbar. Bandhan had moved from Ghosh to Kesh to Sen Gupta in a span of 2 years. Spandana's MD Shalabh Saxena, who had pushed back on the over-leveraging thesis, had exited, replaced by Ashish Zabani as interim CEO. Fusion brought in Sanjay. The cycle had churned leadership across the sector, but the data was now more important than the names on the door. The deleveraging that the MFIN Guardrails had set in motion was showing up in every company's investor presentation with striking consistency. The over-leveraged borrower pool that had caused the crisis was being systematically drained. Muthoot Microfinance saw the same pattern from industry-level data. And the proof that the Guardrails were producing a fundamentally better book, not just a smaller one, came from Equitas. New loans written under new rules were performing at pre-crisis levels. Spandana's data was even more definitive. Its FY26 disbursement were tracking at 99.9% collection efficiency. The problem had been in the origination standards, and the Guardrails had fixed the origination standards, and the new book was proving it. Fusion Finance, which less than a year earlier had reported covenant breaches and a 693 crore quarterly credit cost, showed a steady trajectory of decline. Muthoot Microfinance, which had posted a loss-making FY25, reported a small but symbolically significant quarterly profit of 6 crores. Modest, but the direction mattered more than the magnitude. In April 2025, Guardrail 2.0 kicked in, tightening the lender cap from 4 to 3 and further restricting indebtedness limits. Some companies like Spandana had already implemented stricter rules from January. The immediate effect was another spike in rejection rates and temporary pause in recovery of collection sentiment. Utkarsh Small Finance Bank CEO noted this disruption. But by Q2 FY26, the adjustment was absorbed, and the tone in earning calls shifted from cautious optimism to something closer to relief. IDFC First Vaidyanathan, who had spent 5 quarters absorbing microfinance losses, said what many were feeling. Microfinance issue is behind us. By Q3 FY26, that's December 2025, the normalization was broad-based. Collection efficiencies across the sector had returned to 99.4 to 99.7%, close to or at pre-crisis levels. Monthly par accretion, the rate at which new loans fall overdue, had also collapsed. Credit Access reported the number at 18 basis points in December, down from 47 basis points in September. Fusion Finance returned to profitability, a PAT of 14 crores. Its new CEO described this as an inflection point. Lenders who had pulled back from the sector during the crisis were returning. Fusion noted that several banks have freshly opened up, and institutions that were in wait and watch mode had started actively re-engaging. The wholesale funding squeeze, the second order effect of credit cycle, was also easing. RBL Bank's JLJ dispersals had crossed 700 crores monthly with early bucket collection efficiency at 99.5%. Bandhan declared the degrowth phase in its microfinance book over. Muthoot was back to normalized disbursements of 850 crores a month. Ujjivan reported collection efficiencies of 99.7% in December, the highest this current fiscal, with 10 out of 10 states at 99.6% or above. Satin Credit Care's HP Singh, who a year earlier had been deploying 1,100 dedicated collection staff to manage overdue buckets, offered a simple verdict. And Equitas Vasudevan, who had been first to diagnose this crisis as self-inflicted, delivered a closing line for the cycle. Now, while the MFI players had been fighting for survival, the large diversified banks had watched from a very different vantage point. HDFC Bank's microfinance exposure was less than 1% of its total book. SBI's chairman noted that their MFI portfolio, around 10,000, 11,000 crores, does not really add up to anything. And by Q3 FY26, HDFC Bank's deputy MD was using the language that felt like it belonged to a different industry altogether. A Cinderella phase for large banks, a near-death experience for several MFIs. The same economic cycle experienced at different altitudes, depending on how much microfinance a company carried on its book. The industry that emerged from this cycle was not the one that entered it. The changes were structural, deliberate, and in some cases permanent. Every major player shrank its MFI portfolio as a share of its total assets. Equitas took its MFI mix from 20% to 8.5% and intended to stabilize at 10%. IDFC First expected its microfinance book to bottom at 7,500 crores, half its peak. Bandhan's non-microfinance book now accounts for 63%, up from 45% 2 years ago. RBL shrank its book by 23% and targeted keeping it at 6 to 7% of its advances. The consensus was that microfinance at 7 to 10% of the balance sheet is fine, not 20%. Companies are also insuring against the next cycle. CGFMU, the Credit Guarantee Fund for Micro Units, had existed before the crisis, but was lightly used. Now it was becoming the standard. RBL reached 80% CGFMU coverage on its standard GLG book. IDFC First had been insuring since January 2024, one of the earliest movers. Kotak Mahindra went further than portfolio caps and insurance. It did something even more fundamental. It replaced the joint liability group model itself. It was quite an admission that the JLG model, the foundational innovation of microfinance, had weakened. Social pressure among group members was no longer enough to ensure repayment in an environment where borrowers had loans from 5 different institutions. Individual credit assessment, powered by bureau data and machine learning, was being layered on top of or replacing the group guarantee. And the baseline expectations for the business had permanently shifted. The old normal of 1.5 to 2% credit costs were gone. Vasudevan was explicit about what the new normal looked like. 3 to 4%, not 2. The industry had recovered, but to a worse steady state than before. The premium for lending to the segment had been repriced, not by the regulator, but by experience of the companies. Vasudevan also offered the most honest structural assessment of the sector, one that explained why every company was simultaneously declaring the crisis over while also reducing its exposure to the business that had built them. The industry had survived, the cycle had turned, but the companies that came out of the other side were building for a different future. One where microfinance remained in the portfolio but never again dominated it. And that was it for today's edition. I know it was long and I'm sorry for that, but if you liked it, do share it. And if you didn't, do give your feedback as well. Hopefully, see you in the next one.